like to put the whole thing on a spreadsheet, and I would normally use this for a given project to work out exactly what the NPV is. Don't worry about all of the arrows and numbers, it's just one example of an investment appraisal, and it ends up with giving you your NPV bottom right here. So let's start and do this one row at a time. Let's see how we go. Again, let's assume this is over a 5-year period, with year 0 being the first year where the project is being undertaken. Keeping the numbers quite simple, let's suppose that the project budget, as per the project management plan, shows that it's going to cost us £150,000. And let's suppose it's a nice exact 1-year project. So at the end of year 0, the end product of the project goes into operational use. Let's again just assume it's a new computer system or something. And the overall costs of running this on a yearly basis is £25,000 in the first year, £25,000 in the second year, and indeed in the third year. After year 4, because we've thought this through carefully, we realise we might need to do a bit of an upgrade, either to replenish parts that are wearing out or to take advantage of emerging technology. And this would cost us £35,000 in year 4 and a further £30,000 in year 5. Okay, so there's our costs. Let's talk about the benefits. None in the first year because we're still delivering the project. In the first year of operations, we make an extra £100,000 as a result of this new system. Year 2, £150,000. Year 3, year 4, and year 5. So this is year on year only. I'm not showing you any totals here. What about cash flow? Well, we're £150,000 down in year 0 because we're delivering the project, and that's what the project will spend. In year 1 of operational life, we now look at the difference between the benefits and the costs, giving us £75,000. Okay? Money in, money out. There's the difference. So we banked, if you will, £75,000 in the first year of operation. Again, it's a difference in each case. Just relating to year 2 alone, we banked £125,000 and so on and so forth. In year 5, we banked £370,000, again by the difference between these two numbers. So far so good, but the first 3 rows here take no consideration of the time value of money. So this is where we need to start working our magic formulas. Let's just look at the cash flow year on year. Year 0, we're £150,000 down. We're still £150,000 down at the end of year 0. In year 1, the first year of operations, we generate an extra £75,000 of cash, but we need to pay back, notionally, year 0. So now we only owe the bank, if you will, £75,000. In year 2, we've actually generated a net income of £125,000, paying this back. Now we're in the black, so to speak. If we're merely thinking of payback period, we've paid it back in the second year. And in fact, we've done better than that. We've got £50,000 sitting in our bank account, if you will. In year 3, we generate an extra £175,000. There's no paying back. We simply add those together, and we've now got £225,000 sitting in the bank. Carrying on doing this, in year 5, if we looked in the bank account and counted it, we would truly find £960,000 sitting there. That's a fact. So now we need to start working some of our magic using the time value of money. Let's assume a discount factor of 5%. In year 0, while we're still delivering the project, the discount factor is 1. So those numbers remain. But in year 2, now watch carefully, and this is why these arrows are important to help draw your eyes. Although we made £75,000, it's only worth 0.95 of that, as viewed from the present day, so that is now £71,000. I'll do one more. In year 2, although we made an extra £125,000, it's only worth, as viewed from the present day, 0.91 of that, making this £113,000, and so on, and so on, and so on. In year 5, just one more time, we actually made in that year alone an extra £370,000, but notionally multiplied from the discount factor, it's only worth 0.56 of that, which is £206,000. Now the final piece. The cumulative discount factor now needs to be brought into play, which means taking the cash flow into consideration. In year 0, we're still £150,000 down. But here's where we get the final result. In year 1, which you've agreed hopefully from the previous row, we've actually, as viewed from the present, got £71,000. Even though there's in reality £75,000 in the bank. We now subtract that and start paying back our loan, if you will. So 150,000 minus 71,000 gives us £79,000. So we've made a big dent in our loan, but we're still this much down. Year 2 is again where we go into the black. We have £113,000, even though it's been applied by 0.951. Notionally, we pay that back, and we've got £35,000 in the bank. We continue doing that right up to year 5, again paying back each time. Since we went into the black here, or the positive amount here, we're ending up in year 5 having £644,000. But, and here's the important but, if you counted the money in the bank, you would find £960,000. But because it's viewed from the present, the time value of money, as an investment, it's only really worth £644,000. So this cumulative discounted cash flow at the end of the repayment period is what we call the net present value, NPV. And again, the higher this number, the better it is. So that's about as complicated as it gets.